First, just a little bit of history. Global production of biofuels, it's really a success story. You can see how far we've gone since 2005, both in ethanol and in biodiesel. The U.S. and Brazil are the leading ethanol producers in the world by a long margin. And the U.S. and the EU are the leading biodiesel producers in the world, again, by quite a margin. The early leader in the biofuels industry was Brazil with sugarcane ethanol. Then the U.S. came along in the early 80s with corn ethanol production. And early on in the U.S., in EU, and in Brazil, biofuels were subsidized. That was the way that they came to market. But since then, in all three regions, we've moved from subsidies to mandates. The mandate here is called the Renewable Fuel Standard. Basically, governments found as the production grew through time, the budgetary cost of subsidizing these large volumes that you just saw of biofuels became a significant burden. And so they did what governments do. They moved from direct subsidies from the Treasury to putting the cost onto the consumer. That's what a mandate does in economic terms. So that's sort of, in a nutshell, some of the history. In the United States, we had three major objectives when we launched our biofuels programs: reduce oil imports and reduce the dependence on foreign oil, to increase farm and rural incomes, and to reduce the environmental pollutants from fossil fuels and reduce greenhouse gas emissions. I think it's fair to say that we've succeeded in all three of those domains. We've accomplished all three of those objectives. So looking at that metric and from that perspective, our program has been a tremendous success. We've had a lot of legislation, a lot of congressional decisions on how to shape the program as we've marched through time. It originally began with legislation in 1978. That was the first ethanol subsidy. It was 40 cents a gallon at that time. And it stayed in that neighborhood through the point at which it was terminated in 2012. Then we had the Energy Policy Act of 2005 and the Energy Independence and Security Act of 2007. They created what's called RFS-1 and RFS-2. RFS-1 never really was binding. The market was charging ahead faster than the Renewable Fuel Standard was at that point. But then with the Renewable Fuel Standard 2 in 2007, that began to pull more biofuels into the market. So we've had tremendous growth in both ethanol and biodiesel. Now, this Renewable Fuel Standard that was created in the Energy Independence and Security Act of 2007 is quite a piece of art. It has 4 different categories of renewable fuels: biodiesel, cellulosic advanced, other advanced, and conventional. It's a nested structure, and in that nested structure, the only category that permits corn ethanol is the conventional category, but all the others can go into that category as well. Cellulosic can go into that category. Biodiesel can go into that category. Cellulosic and biodiesel can go into other advanced. Sugarcane ethanol can go into other advanced. And there are different RINs, different renewable fuel identification number buckets for each one of these categories of the Renewable Fuel Standard. So it's a creative system. Until this past year, it had worked quite well. At least in my view, it had accomplished what it was designed to do. This graph you've seen many, many times. I only put it out here to show one thing. The yellow at the bottom is corn, the blue is cellulosic, and the green and the red are other advanced in biodiesel. The blue, though, the cellulosic, there's a big off-ramp. The people who, the obligated parties for cellulosic have 2 ways they can meet their obligation. One is by blending cellulosic biofuel. The other is by buying a credit from EPA and buying a RIN, an advanced biofuel RIN. The cost of those 2 today would be about $1.40. And so if it's more expensive than $1.40 to blend, you're just going to buy your way out of it. And that's a pretty, it's an off-ramp. It means that the cellulosic part of this is not really binding in the sense that there's a cap on it. The obligated parties are refiners and importers, it's enforced through RINs, Renewable Fuel Identification Numbers. If you're a refiner and you have 10% of the domestic gasoline-type fuel market, in 2013, the RFS was 13.8 billion gallons total, so you would be obligated to turn in 1.38 billion gallons of RINs at the end of that year. It's a tradable, the RINs are tradable, so they can be bought and sold, but only about 20% of them are actually traded. Most of them are just generated and turned into EPA at the end of the year to satisfy the Renewable Fuel Standard obligation. This is what the market for at least corn ethanol RINs has looked like over time. If you go back to the left, before this graph begins, the RINs had a value of about 3 cents. The RFS basically wasn't binding. The market was ahead of it. But then you can see the RFS became binding. RINs took on real value. Right now, they're sort of in a holding pattern. Corn is sitting at 70 cents. It's been that way for a couple of months. And the others about a dime or 13 cents a gallon more than that, because nobody knows what the future is going to hold, because nobody knows what EPA is going to do with the Renewable Fuel Standard. So it is really difficult for this market to function in any way today. Now, you're all familiar with the blend wall. The blend wall is this blending limit. We consume about 135 billion gallons of gasoline-type fuel a year. That means that if we blend it at 10%, which is what we do for most of it, that the max we could blend is 13.5 billion gallons. This year, the legislated renewable fuel standard is 15 billion gallons. So the legislated renewable fuel standard is higher than this blend wall. Same was true last year. The legislated standard was 14.4 billion gallons. Blend wall was there. EPA said in their provisional announcement that, oh, well, we can't require people to go beyond the blend wall, so they set the RFS provisionally at 13 billion gallons for corn ethanol. So that was part of the rationale they used. A number of us think that that just says, it sort of defies the logic. The whole renewable fuel standard system was designed to let the market in RINs work, to let the system function. If there's a problem to be surmounted, then the price of RINs goes up. You blend more E85. Bruce Babcock and I and others have argued that there's significant potential for expanding E85 blending. We have 17 million flex fuel vehicles. If you take those flex fuel vehicles, multiply by the miles they're driven per year, to factor in the mileage of the vehicles, we're using about 2% of that capacity in E85 vehicles for E85. Now, if we said to the industry, if the RFS were maintained and the industry were obliged to blend more, what would happen to the price of RINs? The price of RINs would go up. What would happen to the attractiveness of E85? It would go up. We would blend more. We would take advantage of this 17 million flex fuel vehicles because it would be attractive for people to use, to sell and to buy E85. This was certainly true last year in 2014 when the price per gallon difference was $1 a gallon. Today, it's 30 cents a gallon. So it's a little bit less attractive, not quite as easy to argue that this would actually work completely. Now, a little bit more on the history of the industry. This is the historic ethanol and gasoline prices. Green is ethanol, blue is gasoline. And you can see until about 2009, ethanol was more expensive than gasoline. Here's the same graph just with the price ratio. So it was generally above 1 prior to 2009. But then after 2009, it was less than 1. It was cheaper than gasoline. The oil industry decided, hey, here's a source of octane, 115 octane. Here's a source of oxygen. It's cheaper than gasoline. I can produce a lower octane gasoline out of the refinery, blend it with 115 octane ethanol, and get an 87 octane to sell at the pump. The whole system, starting about 2009, was modified to take advantage of these properties of ethanol. And that's where we are today, that the whole system does make use of ethanol. Big question is what happens now? Most advanced biofuels, except the niche markets, take about $140 crude, by my estimate, to be economic without a subsidy, without a mandate. Before the plunge in crude oil prices, we were close. And we were making progress on many technical fronts such that we were getting much, much closer. Today, you can buy crude oil out through 2023 for $70 a barrel. By the way, Jim, it's 46 today. It fell 24%. So you can buy today crude oil on the futures market. The futures market's always wrong, but it is one indication of what the market's thinking now about the future of crude oil. So this is going to mean difficult times. It's going to mean persistence is going to be required. It's going to mean that we're in a different world. And I'm sure I haven't been here this week, so I don't know what you've been talking about, but I suspect this has been a big part of it. One of the reasons I'm optimistic about biofuels is because I'm optimistic about aviation biofuels. The Navy and the Air Force, I understand Secretary Mavis was here and he came to Purdue, and that's one reason I'm excited about this area. The Navy and Air Force are very keen on biofuels. The International Civil Aviation Organization is very interested in biofuels. We're working with them. We're working with the Alternative Fuels Task Force of that organization. And they are very keen on moving biofuels into the aviation fleet. And on the ground, there are a lot of things you can do. You can do electric vehicles. You can do compressed natural gas. You can do ethanol. In the air, if you want to be greener, it's biofuels, drop-in biofuels. Now, here's just one particular technology. We're doing what we call stochastic techno-economic analysis of a lot of different aviation biofuel pathways. This is jet fuels via pyrolysis. And you can see here, the way we do this is we have uncertainty in capital cost, uncertainty in feedstock cost, uncertainty in hydrogen cost, uncertainty in fuel yield distributions. For pyrolysis, there are two of these. One is the feedstock to the bio-oil, and the second is the bio-oil to the final product slate. And we take the inherent uncertainty in all of these parameters, we run them through a simulation, Monte Carlo simulation model, and we can simulate the distribution of net present value that reflects all the inherent uncertainty. That's the upper right graph. And we can simulate the distribution of break-even prices, and I think that's more important, that reflect all of that uncertainty. So, because the 50-50 price, the break-even price that's reported in a lot of the engineering literature, that's the price about half the time you make money and half the time you lose money. How many of you want to make that bet? Maybe not everybody in the room is willing to bet on a 50-50. So it's really important to provide to investors, to provide to decision makers, what does that distribution of break-even price look like? What's the 25th percentile? What's the 75th percentile? What does the whole distribution look like? So that's the bottom right part of this graph, and that's one of the things we're doing for a whole flock of different aviation biofuel technologies. We can also test the sensitivity analysis. What are the factors that are really important? And this helps in channeling research to the things that matter most in reducing the cost. In fact, this is something that Secretary Mavis asked for. He said when he came to Purdue, could you tell us how bid prices might be affected by the length of the offtake contract? And so we did that. We estimated with this break-even price distribution how the price might change with a 5-year contract, a 10-year contract, a 15-year contract. And as you can see, $5, $4, $3, it changes a lot with the length of the contract. And so this kind of policy provision is something, if the Navy had the legal authorization, and they don't, if they had the legal authority to contract out, then they could save themselves and the government quite a bit of money. Okay, my conclusions. The RFS is really important for biofuels. Because of the blend wall and other issues, it's now come under increased attack. Eliminating the RFS would kill renewable fuel growth. But ethanol likely would continue to hold its ground, at least in the short run, even with today's lower oil prices, because it has become such an important part, an integral part of the system. I think the greatest potential for biofuels growth is in the aviation sector, and the key to stimulating that growth will be policies and funding mechanisms that reduce risk for potential private sector investors. Thank you.